is between the originator bank and the special purpose vehicle, meaning that the originator bank sells the securitized portfolio to the special purpose vehicle. So the originator bank doesn't own anymore the asset which are the object of the securitization, and the special purpose vehicle, in order to finance the acquisition of the portfolio of assets from the originator bank, issues notes which are placed to the investor. These notes are called asset-backed securities, ABS. Asset-backed securities. So, once again, the originator bank sells the portfolio of assets to the special purpose vehicle, so it's a true sale, and the special purpose vehicle finance the acquisition of the portfolio issuing notes which are called asset-based securities. So we are not talking about anymore credit-linked notes, which is typical of the synthetic securitization, but we are talking about asset-based securities. In the slides I gave you, there is an overview of the market, so you can read about that. But let's talk now about the structure of the deal. So, we got an originator bank which owns the loan portfolio. Let's suppose that we are talking about loans. The loans are sold to the special purpose vehicle. The special purpose vehicle finances the acquisition, issued asset-based securities. Okay? Now, let's compare the two transactions, the synthetic securitization and the cash securitization. The synthetic securitization, as explained before, is mainly done to release regulatory capital from the originator bank. One of the main purposes of the cash securitization is to provide liquidity, to provide funding to the originator bank at a cheaper price than what would be the price if the originator bank finance itself directly into the market. Let me explain. An alternative, a traditional alternative of financing for the originator bank, apart from the deposit, which let's not consider now the deposit, is to do what? Just to issue bonds and place these bonds into the market, no? So I'm a bank, I issue a 5-year floater, I will pay a premium which is a function of my rating to the market, and I will finance myself, just issue these bonds, okay? Now, I can get a cheaper funding by doing a cash securitization, meaning that I can get a cheaper funding by selling a part of my asset to a special purpose vehicle and then issue in the market asset-based securities. Why? Let's suppose that we are talking here, usually, about a mortgage loan portfolio. Okay? So, why do you think that the cash securitization could be a cheaper way of funding than the traditional issue of bond?
Because you can have the mortgage loan you had before, which is not a very
No, wait. Before you do consideration about subprime and everything, you know, that is a poor parlay. It's like to talk about football. Now, before we understand the structure, and then we talk about football, okay? So if you don't know the structure, you don't know why the crisis happened, correct? Okay, now, so let's stick to the structure.
Well, the average cost of capital, I mean, the return I have to pay to investors is smaller than the returns I get from the loans, then I would make
No, okay. This is not true, okay? No. I would say that, of course, the return I pay to the ABS investor plus the cost of the transaction are less than what? Then the return I should pay to the investor if I issue directly the bond. Correct? So that's simple. But why this happens? No. Sorry?
We have a low rating U.S. bank. We have a low rating and you use the public very high interest rate. While you tranches,
Exactly. We are almost there. So basically, let's say like, if the portfolio, for example, if we got like, usually these transactions are done with a loan mortgage portfolio, okay? So a loan mortgage portfolio is usually safer than the risk of the bank which issues. Why? Because, for example, a loan mortgage portfolio has got like first lien. So basically, you remember when we talk about recovery rate, that kind of recovery rate which apply to mortgage loan is the senior secured, which, if you remember, was around 70%. Because the bank which gives the mortgage has got a lot of guarantee. For example, if I give a mortgage loan, my guarantee is the house or the flat that my customer is buying. So if the customer doesn't pay, what I do is just to sell the property and get the money back. Correct? Now, the point is, just to give you this simple example, is the following, that when I securitize, for example, a mortgage loan portfolio, what the investors are doing by buying ABS, apart from the tranching, is to buy the credit risk of the mortgage portfolio, which is usually better than the credit risk of the originator bank. So due to the fact that the credit risk of the mortgage loan portfolio is better than the credit risk of the originator bank, I can get, as an originator bank, a cheaper way of funding than considering alternative traditional options such as issuing a bond. Okay? But now, why technically this happens? Because in the transaction we use a special purpose vehicle. Okay? So the special purpose vehicle insulates the credit risk of the originator from the credit risk of the loan mortgage portfolio which has been securitized. Okay? So using a special purpose vehicle, as an investor of ABS, I don't have to look anymore at what is the credit quality of the originator, but what I look is the credit quality of the portfolio which has been securitized. And if the credit quality of the portfolio which has been securitized is better, like it usually happens, than the credit quality of the issuing bank, I can get finance in a cheaper format than the traditional issuer bond. Because you understand from this chart that the SPV receive cash. from issuing asset-based security, but these cash flows, as you can see, go back to the originator bank. Okay? Whilst in the synthetic securitization, nothing like that happened. Because if you remember, the synthetic securitization is a transaction which is done at a pure cost for the originator bank. Because when it enters a synthetic securitization, the originator banks pays a premium which goes to the special purpose vehicle, which goes to the investor. Here, the return of the investor is strictly related to the return of the portfolio which has been securitized. Okay? So, the risk and the return for the investor of the asset-based securities is the risk and the return of the portfolio which has been sold to the special purpose vehicle. Okay? So, that way, one of the main purposes, which is getting a cheaper cost of funding through using a securitization, is achieved. Then, we enter into the consideration of the tranching, exactly like we have seen in the synthetic securitization. But we will see that later. Now, let's go back to my main point, which was, what's the difference between a synthetic securitization and a cash securitization when, as an originator bank, I want to achieve the objective of releasing regulatory capital? My question for you, and pay attention, is, if you are an originator bank and your main purpose is to release regulatory capital, okay? Would you opt for a synthetic securitization or a cash securitization? Let me give you just a simple case study, okay? Let's suppose that the originator bank has got 3 different categories of assets in terms of credit quality. Let's suppose that on the asset side of the balance sheet of the originator bank, we've got 1/3 AAA rated loans, 1/3 single A rated loans, and 1/3 BBB rated loans, okay? So again, the originator bank has got 1/3 AAA, 1/3 single A, and 1/3 BBB, okay? Now, due to the composition of the asset, like the way I told you, the rating of the originator bank is single A, okay? So 1/3, 1/3, 1/3, and the result of this composition of the portfolio is that the rating agency gives to the originator bank a rating which is single A, okay? Again, the main purpose for this, for the originator bank is to release regulatory capital, okay? So my question for you is, would you opt for a synthetic securitization or a cash securitization? In order to answer this question, I got another question for you, which is, we are under Basel I, just to keep the things simple, okay? And you got this loan portfolio, which is AAA, single A, and BBB, 1/3, 1/3, 1/3. And you want to do this securitization. Now, the asset category which you would securitize is the AAA, the single A, or the BBB? Who answer me? The? Why? No, you have to choose one. Okay. Why? That's good. That's a good point. But I'm asking you, if you think about the BBB, I told you that we are under Basel I. So what's the trick here? Eh? Bravissima, exactly. So if you keep on the, let's say I do a cash securitization and I give away the BBB. So in my balance sheet I got now only AAA and single A. Good. What's the point here? Exactly. We are under Basel 1. So, in terms of capital absorption, they are all the same. But, in terms of return on regulatory capital absorbed, I'm keeping on my balance sheet the assets which are wasting my return on regulatory capital. Because I got a AAA which basically pay me, I don't know, Euribor minus or Euribor flat. And remember one thing, if I got a single A rating, just to simplify things, we said that last lesson, meaning that my cost of funding will be compared, if I don't do a securitization, to a single A rating, correct? And I'm investing in AAA rated asset, which gives me a return which is lower than my cost of funding. So I'm not in a financial equilibrium, okay? So, in theory, due to the paradox of Basel I, the asset I want to securitize are the best one. Because anyway, if I look only, not at the credit risk, because I told you, my main purpose is to have a better efficiency in terms of regulatory capital, is a paradox, but I want to securitize the best asset in terms of credit quality, which are the AAA. Everyone gets this point? Okay. Now, if I understand that the AAA are wasting my return on absorbed capital, okay? What kind of securitization would you like to do? The synthetic or the cash? Can you answer me? You, yeah, yeah. That's good. Why? I don't get it. If we said that the target of my securitization are the AAA assets, okay? And you told me that I want to do a cash securitization, what will happen? What will happen? You have to sell the AAA asset, correct? Now, if you sell the AAA asset, what happens? Meaning? I cannot hear you. Exactly. And jeopardizing also the rating of the bank, which was single A. Because you end up having on the balance sheet single A, triple B. And we said before that one of the assumptions was, to have a single A rating. So it's not the right answer. So the right answer is why? Because? Yeah, but why synthetic? Sorry? Exactly. Because the asset, the AAA asset, remain in the balance on the balance sheet of the bank. They don't go out. So the balance sheet composition is the same, but I get a better efficiency in my return on regulatory capital. Yeah. Shh, please.
How can you transfer AAA loan? How can you transfer it back to the mechanism which then you transfer AAA, AA?
No, but that we have to describe later, okay, when we talk about the structure.
AAA loan. So AAA, how do you transfer it back to an equity tranche and then to
Or you can tranche whatever, meaning, again, I mean, the point is that when you, okay, this was a simple example, okay, because I mean, just to give an idea of why you want to do a synthetic securitization when your purpose is to free up regulatory capital, having a good quality credit portfolio, okay? But then, again, apart from AAA, AA, single A, whatever it is, the portfolio, the tranching, meaning that you are taking a risk, if you are an equity holder, which is higher anyway, of someone else. You know what I mean? AAA can have a probability of default, let's say 0.001%, whatever, or 0.1%, okay? Whatever is the number. Now, the point is, when I tranche, it's not about the portfolio, but it's about which is the first one to default. So if you are the equity holder, you are the first one affected anyway. So you can, you know what I mean? Please. Shh.
So we think that you guys will bond loan because we keep them on the balance sheet, so we can preserve it to the single A.
Yeah, they say the quality of the balance sheet. Okay.
But if I do synthetic securitization, then I will get protection on those, right?
Yeah, because you need to have for regulatory purposes, not because you really want to have it.
So if I securitize, I get protection.
Yeah?
Then, in terms of regulatory capital, should the risk weight should be a function of the minimum between the rate of the asset, the risk weight of the asset, and of the guarantor, right?
Yeah, right.
So if, in theory,
But I'm under Basel 1.
it doesn't work.
In Basel 1, it's not about the rating. You remember? In Basel 1, you got three, let's say, in reality there are four, but whatever. Let's simplify. Three risk weighting factors. 0% OECD country. Okay? Government bond from OECD country. 20% banks. The rest of the world, 100%. So it doesn't depend upon the rating.
So if we were in this,
If, that's a question that exactly is correct, if we were in Basel II, who answered this question? Why it should, it would be convenient anyway, and when it would be convenient to do a synthetic securitization under Basel II? Who answered me? Who answered?
when the rating of the guarantor is higher than 9,
Exactly. Especially if you go into another bucket. Let's say that your guarantor is a AA bank, which can happen, and your assets are, on average, BBB. The BBB bucket will attract a risk weighting factor under Basel II of 100%. The AA, how much? 20%. Okay? So still, you've got, it's convenient to realize a synthetic securitization. Is that clear to everyone? Or even like, if you got a bank which is a guarantor, which is a single A, and your asset are BBB, still you get 50% against 20%, no? No, sorry, well, 100% against 50%. Okay? So you can play with that. Is that clear to everyone? Now, let's go back to the cash securitization. So, the portfolio has been sold to the special purpose vehicle, which issue asset-based securities. It receives cash flow, which are given back to the originator bank. The risk and the return of the ABS, of the asset-based securities, is, excuse me, the risk of and the return of the asset-based securities is the risk of the return of the portfolio. There is no more link with the originator bank. Okay? Again, we'll have a tranching, so we'll have equity, mezzanine, and senior tranche. Two things. First of all, again, usually the equity tranche is retained by the originator bank. Now, why don't you ask me why the equity tranche is retained by the originator bank. Because you know the answer.
Because you want the originator bank to give very bad loans to this kind of securitization with very bad loans, so you keep the equity tranche within the originator bank, so it's incentivized to give good loans.
Exactly. Meaning, to explain a little better, that the originator bank retains the equity tranche in order to align interest with the mezzanine and the senior investor. So in order to avoid a moral hazard effect by which, after the deal has been done, I don't care anymore as originator bank what happened because I don't have any more risk in my balance on my balance sheet. Whilst if I keep the equity tranche, which is the riskiest portion of the portfolio, which has got the first loss risk, so meaning that the first default happen will affect the originator bank, I'm giving a signal to the market that our interests are aligned. Because if something bad happens to the portfolio, I'm the first one as an originator bank to be affected by this. So, keeping the equity tranche is a strong signal of alignment of interest between the originator bank that organized the deal and the mezzanine and the senior investor. And the same was true for the synthetic securitization. And of course, sometimes it happens that it's impossible to place the equity tranche to the investor because they say, forget it. But that's another question, okay? Let's say from a theoretical perspective, the point here is that you make an alignment of interest between investor and the originator bank. Now, the cash securitization is a little more complicated in terms of structure than the synthetic securitization. First of all, why is it a bit more complicated to organize? First, because there are a lot of counterparties involved in the deal, which we didn't see before in the synthetic securitization. Second, because the asset categories which are typical of the cash securitization are very, very, very different asset classes. Here an example. We can have securitization on mortgage. We will have residential mortgage-backed securities, RMBS, which are the ABS, which are placed to the investor when the underlying portfolio is a residential mortgage loan portfolio, okay? Then you've got CMBS when the portfolio is a commercial mortgage loan portfolio. Okay? So RMBS, CMBS. Then you got bank loans, bond loans, you got credit derivative, but that we have seen, commercial credit, credit card, consumer loans, student loans, and so on. Also, future cash flow could be the underlying asset of the of the cash securitization. How? Like, let's suppose that, for example, you securitize the future cash flow that comes, for example, from the national lottery. It was done one in Italy, one in UK. So basically, what you do is to give to the ABS investor the return and the risk related to the forecast of what will be the revenue on, for example, national lottery. Or it could be even like tickets of football team. So the revenues, potential revenue generated by tickets of football team. So the cash securitization could have tangible asset like mortgage loan, but also intangible asset. What is very important here is that you have two assets which have to have given characteristic in order to realize a cash securitization. So you have to have assets which are homogeneous, which are transparent from a risk profile, which gives a cash flow stability, and which have got like frequent payment dates. Why? Because you want to pay the investor of the asset-based securities without interrupting the payment. So that the more frequent are the payment days of the underlying asset, the safer will be the investor of the asset-based securities. So what is important, even if they are intangible assets, is that you can have this kind of characteristic. So a pool of homogeneous assets by nature with predictable, stable, and quantifiable cash flow. That's the most important feature of the cash securitization. Now, let's go back to this chart. Two key points again, which are fundamental. The true sale between the originator and the special purpose vehicle, and the bankruptcy remoteness of the special purpose vehicle. Again, the bankruptcy remoteness is important. In fact, we can insulate the credit risk, again, of the originator bank from the credit risk of the portfolio, which is the object of the securitization, thanks to the bankruptcy remoteness of the special purpose vehicle. So two things, two features which are very important is true sales and bankruptcy remoteness. Then again, we got different asset category, could be tangible, and we see we got lot, or intangible, but the characteristic of the asset have to be transparency, homogeneity of the asset, cash flow which could be forecast easily, and future payment date which are frequent. Okay? Now, we got here, as you can see, more counterparties than in the synthetic securitization. First of all, let's describe this counterparty. The originator bank, we know what is that. Okay? So we don't have any problem. The arranger of the deal is usually the investment bank that structure the deals on behalf of the originator bank. Underwriter placement agent is the bank that is in charge to underwrite or place the asset-based securities to the investor. Usually, the arranger is also the placement bank. Okay? The trustee is basically the function of the trustee is to protect and monitor the transaction on behalf of third parties involved, like for example to monitor on behalf of the investor of ABS that something wrong doesn't happen because let's say the originator bank does some mistake or something during the organization of the deal. The servicer is very important. The servicer is the counterparty which is in charge to transfer the cash flow of the portfolio to the SPV, and then from the SPV, of course, to the investor of ABS. Because you understand one thing here. Let me keep it simple. Who of you has got a mortgage loan? No one? Like one? You. Great. So, you go to your bank, okay, and you ask a mortgage loan, and they give you, okay. Now, what happens? Where do you pay your interest? To whom you pay your interest? To the bank. But what happens if your mortgage has been securitized? You don't know. Maybe your mortgage has been securitized. I mean, it happens every day. I don't want to scare you. Don't worry. You're still safe, but... So what happened? Basically, someone has to transfer the interest that she pays to her bank to the SPV in order to remunerate the investor of the asset-based securities. Because you still have the relationship with the bank, the originator bank, not with the SPV, of course. Okay? So the counterparty who is in charge to transfer all the interest and the cash flow, when, for example, she will repay the capital, hopefully, the one who's going to do that is the servicer. So the role of the servicer is very important, because if you don't have an efficient servicer, then you don't get the payment to pay the ABS investor. Is that clear? Please note that usually the servicer is the originator bank. Why? Because who knows better the portfolio than the one who basically had this portfolio before. And of course, who's got the relation with the customer? The servicer. So the originator bank is also the servicer almost in all cases. In calculation agent, this is not important, okay? Collateral manager is not. Swap counterparty, this is very important. Okay. Usually, when you do a cash securitization, the asset-based securities are floaters. Okay? Everyone knows what is a floater, no? Do you know it? No. A floater is a bond which pays a variable rate. So, for example, if I invest in a AAA ABS, I will get paid, I don't know, Euribor plus 20 basis points. Okay? Usually ABS are floating, so are floater, okay? Now, what happens if the underlying portfolio, the portfolio which has been securitized, is mostly a fixed coupon portfolio? Like, I mean, it's natural, it's not something like, you know? What could happen? What could be the risk of the investor of the ABS? Exactly. If the Euribor rises, increases, then you have to pay more the investor because it's a floater. But at the same time, you're stuck because your portfolio has got a fixed coupon. So that's a problem. And it happens, I mean, normally this kind of mechanism, no? So what you do is to have a counterparty which is a swap counterparty to the vehicle, which swaps the fixed rate with the floating rate, so that you can pay the investor of the asset-based securities. So basically, the SPV enter into a interest rate swap to swap the fixed against the floating. Okay? One thing which is very important, please keep in mind, is that usually there is a requirement in terms of rating for the swap counterparty. So usually we say the swap counterparty has to have a minimum rating of single A. Why? Because the worse is the credit quality of the swap counterparty, the more you are at risk of not receiving this swapped rate. And that is a very important risk. anyway in the transaction. Okay? Another important counterparty is the liquidity line provider. What is the role of the liquidity line provider? Is basically to put liquidity into the transaction if there is a temporary lack of liquidity. Meaning, let's suppose that for technical reason or for a meltdown of the economy, temporarily the investor and the SPV doesn't receive the flow, meaning the interest on the loan, which is used to pay the ABS investor. If that happens, then the liquidity line provider enters into the transaction, provide liquidity so that there is no interruption in the flow of return which is paid to the asset-based security investor, and gives liquidity. But one thing which is very important is that this is not a credit risk. Okay? So if the investor don't receive any more interest on the ABS because there are defaults in the portfolio, then it's up to the investor. It's not like for the liquidity line provider to put liquidity because of a credit risk. It's only linked to a temporary lack of liquidity, and the role is to avoid a temporary lack of payment to the investor for reasons which are not related to the credit risk of the portfolio which has been securitized. Okay? Now, we have described the counterparty, the two key points, true sale and bankruptcy remoteness, the different asset category which could be the object of the cash securitization. Here, just briefly, let's go into the different phases of the securitization. First of all, selection of asset, preliminary analysis of the structure of the issue, determination of the technicalities of the deal, and then true sale and segregation. Then basically the securitization starts. As to the asset, we have already described which have to be like the main characteristic of the asset which are the object of the securitization. Then basically, what is very important is when it comes to determine the technicalities of the structure. Now, we have discussed the swap, so the repackaging. But let me tell you one thing. Here, when we talk about cash securitization, we have, if you are an investor of the asset-based securities, what you do, if you are rational, of course, is two things. First of all, I would like to have a look at the quality of the asset. Like, when I mean quality of the asset, think about asset category, geographical concentration, all the things that we'll analyze later. Let's say an analysis related to the portfolio which has been securitized. But another important feature in the securitization is the soundness of the structure. So basically, means that, okay, I can have a good quality portfolio, good credit quality portfolio, but if the structure is not like so safe, still I have problem being an investor of ABS. So when I analyze a deal like this, I have to analyze the quality of the asset, and we'll do an example later, together with the structure that is presented to me. And in particular, I have to analyze how the credit enhancement is provided. And when we talk about credit enhancement, we got three main forms of credit enhancement. First of all, the creation of subordinated tranche. What does it mean? It means exactly what we've seen before with the synthetic securitization. Okay? So basically, each tranche will have a different degree of risk, which is related to what is the amount of the credit enhancement I've got below my investment. So of course, if I'm an equity holder, I don't have any credit enhancement, and I bear the first loss risk of the transaction. But if I'm a AAA holder, I would like to know what is the credit enhancement which is available to me. Because that credit enhancement will cover me, will hedge me from potential losses in the portfolio. We have seen that. So the creation of subordinated tranche is something that we have analyzed before in the synthetic securitization. And we'll go after with an example. But now, let's see two other new forms of credit enhancement which we cannot have in a synthetic securitization. The second form of credit enhancement is called excess spread. What is excess spread in a cash securitization? The excess spread is basically the excess return I have from the structure when I consider what? The cost of the structure with the return of the asset, okay? So, return of the asset is easy. It's the return of the portfolio which has been securitized, okay? Cost of the structure will be composed of two components. The first one, you can imagine, is what? The return you give to the ABS investor. No? Because the asset-based security is a liability that you have to pay. And the second component of the cost of the structure is the fixed cost exactly of the structure. So the setup of the vehicle, the payment to the rating agency, to the lawyers, to trustee and swap counterparty and the liquidity line provider and so on. You know? So you've got the cost of the structure, which is the return given to the investor who invests in the asset-based securities, and it is a function of, you know, how the structure has been created, and the fixed costs which are there because of the setup of the structure. So again, physical costs like setup of the special purpose vehicle, the lawyer, the rating agency, the swap counterparty, the liquidity line provider, blah, blah, blah. Okay? Now, if I subtract the return of the cost of the structure from the return of the asset, and still I've got something, that something is called excess spread. Okay? Is the return in excess of what I paid to realize the cash securitization. Okay? Okay, usually, keep in mind this, The excess spread is what? Is the remuneration of, guess who? Of?
The high rating of the senior debt.
No.
Of the equity.
Of? Exactly. Usually, the excess spread is the remuneration of the equity tranche holder. Why? Because he is the most exposed to the risk of the portfolio. If the excess spread shrinks, it's not because we pay more the investor, because we decided at the beginning what is the remuneration to the investor. It's because there will be default in the portfolio, which means less return, meaning that the excess spread shrinks. And then who's going to be affected is exactly the equity holder. Okay? And in some circumstances, the excess spread can be used to protect the senior holder, the senior notes holder, if the return of the deal is not enough to pay them. So it's like to say, okay, I agree at the beginning, I booked a AAA, I was supposed to be paying Euribor plus 20 basis points, but now there were some default in the portfolio, so there is not enough money to pay the AAA investor, okay? Given the excess spread. So what I do is just wipe out the excess spread and divert it to the most senior, and then, so AAA, then AA, single A, and so on, in order to restore what was the agreed spread at the beginning of the transaction. Is that clear? Yes or not? Is that clear? Yeah. Okay. Okay? So, the excess spread is at the same time both the remuneration of the equity tranche holder and a way to give credit enhancement to the senior holder of the notes, because in case something happens like defaults, you just don't pay anymore the equity holder, so you don't give anymore the excess spread, but you divert this cash flow starting from the most senior and then going down. Okay? Then, the third form of credit enhancement is the over-collateralization. Okay? The over-collateralization is basically a buffer which is created because the notional of the asset-based securities which are issued is less than the market value, and of course the notional, of the asset of the securitization.
Excuse me, but this doesn't cause a balance sheet write-off in the balance sheet write-off of the originator?
Yeah, of course.
So it happens always because probably it's like, I don't know the margin, what is the actual.
Okay. Okay. Now, why you exactly due to the fact that in this case you got a write-off on the balance sheet of the originator? I mean, first of all, everyone understood this. I don't think so, to be honest, because I had to reply to him. So first, everyone understood what is an over-collateralization? No, exactly. So, again, the notional of the asset-based securities placed to the investor is lower than the market value of the asset, which are market value and of course notional of the asset which are securitized. Okay, so it's like to say I've got a notional of 100 of the portfolio and I issue ABS for €50. First of all, why would I do that and when would I do that? Because, I mean, as correctly pointed out, you'll have a write-off on the balance sheet of the originator bank. Who answer? Why you should do that? Yeah, but why should the originator bank do something like that? When? In which case? Eh? No, no, no. Yeah, but when the default happened? The portfolio should be? Yeah. I mean, what is it, ping pong? So, who can answer this?
If the portfolio is really risky, so you cannot crunch it. I mean,
Okay. Really risky, we are almost there, meaning?
the rating is low.
Meaning?
No higher rating.
Sorry?
No higher rating.
No, I know. I mean, it's the other way around.
Weighted average.
Is when the portfolio, for instance, is a non-performing loan portfolio. So, these are loans given by the originator bank, but they are non-performing. So, of course, the notional is 100, but the value is less because they are evaluated, let's suppose, at the recovery value. So, yeah, you got 100 euro of asset, but their recovery value is 30. So, if you issue ABS for 100, which is a notional, immediately the ABS investor has got 70 euro of losses. So when you do a securitization of non-performing loans, which happens, then usually you issue ABS that are, of course, lower than the notional, because that notional is already not anymore worthwhile, because it's already evaluated at recovery value. But then what you do is also issue ABS whose notional is lower than even like the market value of the loan, because you want to give like less volatility to the ABS investor in case the real recovery value is lower than the one estimated at the inception of the deal. So you are forced to have an over-collateralization, because you cannot issue ABS for the same amount as the notional, because the notional is just, it doesn't indicate anything anymore, because the loans are not performing. Okay? So, exactly. When you do something like that, you have a write-off. But you have anyway the write-off, because, I mean, the loans are not anymore valued at the notional, but they are valued at the recovery value. No, lower. Okay. The market value of a non-performing loan is what? The estimated recovery value. Correct? But it's an estimation. So it could end up that the recovery value is lower than the one you estimate when you do the deal. No? So if something like that happens, the investor will undertake immediately a loss. Because you say, okay, I start the deal, I've got a notion of 100 euro, the recovery value I estimate is 40, and then, you know, I securitize this non-performing loan portfolio. But then it ends up that during the life of the transaction, when the cash flow from the recovery starts to kick in, the recovery value is lower. So you want to have like a cushion to decrease the volatility, meaning the potential loss of the ABS investor. So if you think that, for example, the market value, meaning the estimated recovery value, is 40, then you issue ABS for a notional of 30. You understand? It's just an additional measure of safety for the investor of the asset-based securities. Any question? Now, let's go ahead with there are, excuse me, let's go ahead with the structure. Usually, in a cash securitization, we have a structure which is common to almost all the deal. And basically, this structure involves two main phases, which are the revolving period and the amortization period. What does it mean? When we are in the revolving period, the originator bank has the right to replenish and substitute expiring exposure with new exposure. What does it mean? It means that, let's suppose that here we got a revolving period of 5 years. Okay? So, by contract, the revolving period of this cash securitization is 5 years. Here we got the notional, okay? And let's suppose that the notional of the securitization is 1 billion. Okay? So, think about that. If I, for example, have a cash securitization of residential mortgage loan, okay? And I securitize 1 billion portfolio. Let's suppose, meaning like, I don't know, 100,000, 10,000, whatever it is, mortgage loans that I've given, okay? What could happen to this portfolio during the life of the transaction? Sorry? Some mortgage start? Yeah. How? I mean, yeah, perfect. So, some mortgage, let's say, disappear from the portfolio. Why they disappear? Why do they disappear? Because? No, default, okay. But let's, They mature, is, they just mature, and prepay. That's one of the most important risks in the cash securitization, is a mortgage prepayment. Why do you think that, you know what does it mean prepayment, no? That you are the only one with the mortgage, so I'm sorry. What does it mean that you can prepay? before the maturity of the mortgage, exactly. So why it is a risk for your bank that you prepay? Sorry? Then you don't? I didn't hear you, so I don't know if it's right or wrong. Can you speak louder, please? Yeah? Yeah, but that is exactly what is right in the revolving period, but we'll talk about later. But in general, apart from the securitization, why one of the most important risks for a bank that gives mortgage loan is the prepayment of the mortgage? Can you speak louder so everyone can hear?
Because of the interest flow that they lose, because if they get the full principal, they can pay a penalty, but they lose the certainty of that payment.
Yeah, we are almost there. Can you answer me? You? Yeah. Why is the prepayment risk is so important? The bank, sorry? Yeah, okay. And also, to add this point? Exactly. Which I think is what your colleague wanted to say for hedging, no? Hedging in terms of what? Like you're saying. So is asset liability management, correct? ALM. Correct? So you got this asset and you're saying, oh my God, I'm having this asset, this time profile and so on, and I want to, to match my asset with my liability. But then what happened? Wow. Suddenly I got all the prepayment and what happened? I got not anymore an equilibrium between the asset and the liabilities. So exactly all this reason makes the prepayment risk, by the way, an important feature when it comes to evaluate, of course, mortgage risk and, of course, cash securitization based on mortgages. Okay? So now, in terms of securitization, this prepayment risk can be a bit mitigated for the fact that during the revolving period, the bank can keep constant the notional of the transaction, even there are prepayment or like expiration of the underlying asset. So what the originator bank will do is to replenish assets that expire with new assets in order to keep the capacity of the securitization constant. Okay? And it's very important because, like your colleague suggests, your risk is that if you cannot keep constant, meaning that you have to do a new securitization, but then it comes to the refinance risk. Because it could happen, like now, that the condition of the market change, and then you have to pay more to do a securitization. Okay? So whilst during the revolving period, you just stay on the old deal, let's say old, and you just replenish in order to keep the capacity at the level which was contractually agreed at the inception of the deal. Okay? So this is called the revolving period. Then we've got the amortization period, which basically means that the originator bank cannot do any more replenishment, neither substitution, and so as far as the time passes and the portfolio the portfolio naturally amortizes. Every time a mortgage expires because of prepayment or natural expiration, then the portfolio amortizes. Now, the point is that when we evaluate the risk of a cash securitization, the risk of an asset-based security, what maturity would you consider? If you are an ABS investor, and I propose you a deal like in which I got a given asset category and so on, what is the maturity you would take in consideration? Exactly. When I look at a cash securitization, I don't care about what is the legal maturity of the deal. Why? Can you guess which is the legal maturity of a deal? The legal maturity of the deal is also the legal, of course, the legal maturity of the asset-based security. But guess, what is the legal maturity of a cash securitization? No, I mean, it's no. Answer me. Okay, who answered this has got 1 point in the assignment. Eh? What do you mean? Now look, there is also penalization in case of wrong. And during the amortization period, the originating bank cannot do any more replenishment, so the portfolio naturally amortizes. So if you think about not economic maturity, because that was close to what we say, legal maturity.
I would say try because at the beginning the time we said that we short and the amortization time because we have first.
Yeah, but you still have a risk because you don't know. I mean, you have to think. What you do is in your mind to calculate. Please, in your mind is to calculate a prepayment rate, okay? At the beginning, you say, okay, I calculate the maturity of, the economic maturity of the deal on the basis of a given prepayment rate. And I keep it constant to do it simple, no? And then I calculate exactly what your colleagues say, what? The weighted average maturity of the deal, which is based on the revolving period and the amortization period. When it comes to the amortization period, I have to assume a prepayment rate. But now, my question was, so when I evaluate the ABS, I really take into consideration the weighted average maturity. That's the real economic risk of the deal. So when I buy the ABS, I say, okay, the weighted average maturity is 8 years. Okay. But the legal maturity, guess what will be the legal maturity?
5 years, you can guarantee the 1 million notional capital, the
I
notional
mean,
of the note.
what does it mean that the portfolio amortizes?
It's the end of the amortization period, when the amortization finishes, when the zero value.
Exactly. So, what is the end of the amortization period?
When the value of the portfolio is zero.
Is mean, which is?
Pay the bond with the highest number.
Exactly. The legal maturity of the deal is the longest maturity of the asset which is inside. Because it will happen that the day before the maturity, you'll have just one asset. But the securitization in theory, and we'll see that it's not true, but in theory is still in place. But of course, who's got that risk? Let's say that I got a €1 bond in place the day before the maturity. That €1, of course, is in charge of the equity holder, but all the other structure will disappear. Because, of course, when the portfolio amortizes, also the tranche is amortized. Otherwise, the structure is not economic. Let me get back to this. So, you answered correctly, but you are entered by him. Are you in the same group? No. Two different groups? Are you a group?
Yes.
And you have a group?
I will.
What do you mean, I will?
Now I think everybody will want to.
I don't think so. I mean,
I came late and then.
Okay, so let's talk about number because that's very important in finance. Two groups are dividing the 1 point assignment, so it's half each one. Then, how many people you got in the group? Okay, so you divide by 4, 0.5, and you do the same, and then it's fine for the single thing. I'll take care of your group later. So, you understand the point here? Okay? So meaning that when the portfolio amortizes, just like 5 minutes, okay? When the portfolio amortizes, keep in mind, what's going on? What happened? When the portfolio amortizes, also the notes have to amortize. So, when the amortization period begins, what happens is also the notes start amortizing, starting from the most senior. In fact, you will see that in the cash securitization, you have different weighted average maturities for each different rating of the notes. Why? Because when you assign the rating, you keep in consideration also how fast your note will amortize. You understand? Let's say that this is 1 billion, and I don't know, at year 6 we got what? I don't know, let's say 800 million. Okay? So I got 20% amortization. What will happen? Also on the liability side, I will have the same amortization, meaning that 20% of the ABS which I issue will disappear. And guess, starting from what? The equity? No. The most senior. Because of course, if you get repaid faster, it's better for you. Okay? Because you are investing in a shorter maturity. So that 20% will be reflected also in the fact that the 20% of the liabilities, i.e. the ABS, will amortize. Starting from the most senior and down to the capital structure, into the capital structure. Okay? Why? Because think about a scenario in which the assets amortize and the liabilities don't. What happens?
You have to bring back the non-trade fund back.
No, but you are in the amortization period, so you cannot invest.
You keep it there.
No, meaning that the structure is not anymore economic viable because you get less return and still you have to pay the same on the basis of the same notion, no?
But on the other hand, it could be also useful to pay back actively because
Sorry?
it could be also useful to pay back first actively because if the market starts to one.
Yeah, but if you pay back equity, then it disappears, correct? And then who's undertaking the loss? It is the equity. Sorry, I mean.
So it never paid that?
Sorry?
Never paid that.
The equity is stays there until the legal maturity in theory. But then we see that there is an option which is typical. It's called the cleanup call, which when the portfolio amortizes to a certain extent, then the deal can be cancelled. Because otherwise it's not, Any questions? Just let me tell you, give me last 2 minutes. Then, in the cash securitization, some events can happen, and they are called early triggers event. You see in the slide, early triggers event, which basically makes the portfolio amortize faster. We'll see later, but just to give you an idea, it could happen that during the revolving period, let me explain. During the revolving period, this trigger event happens, so meaning that the originator bank has not anymore the right to do replenishment or substitution. So the amortization period starts before the due time. Let's suppose that at year 3, an early trigger event happens. The amortization profile is like that. Okay? An example of early amortization, early trigger event is, for example, when the transaction reaches a given level of default rate. You can read like the offering circular and say, if in the portfolio 1% of default rates will happen, then the originator has not anymore the right to do substitution. Then what happens? We start the amortization period before the due time because of the riskier profile of the portfolio. Because the idea is to protect the investor. The idea is, even if we are in the early stage of the transaction, default rate happens so badly that the investor wants to go out as fast as possible from the investment. The only way to reach this objective is to start the amortization period before, so that the weighted average maturity of the deal is shorter, so that the investor is in a better position. Because the portfolio basically show real signs of credit deterioration. Okay? So one way to protect the investor is to insert this early trigger event, into the deal that cause the amortization period to start before because, for example, of credit deterioration of the underlying portfolio. So that weighted average maturity is shorter and better risk profile for the investor. Okay? I'll see you later then.